The foundations of American economic power are shifting beneath our feet. For decades, the United States dollar has served as the world's reserve currency, the unquestioned medium through which nations conduct trade, settle accounts, and anchor their financial systems. But today, something fundamental is changing, and it's happening faster than most people realize. We're witnessing the early stages of what could become the most consequential economic transformation of our generation. BRICS nations, Brazil, Russia, India, China, and South Africa, are systematically moving away from dollar-based transactions in one of the world's most critical commodity markets, iron ore. This isn't speculation. This isn't theoretical. This is already underway, and the implications reach far beyond a single commodity. What's happening in the iron ore market today could reshape global finance, recalibrate political power, and fundamentally alter the economic landscape that has defined the post-World War II era. Tonight, we're going deep into a story that mainstream outlets have barely touched. We'll explore how China is leveraging its massive purchasing power to push its currency into global trade, why India, a traditional American ally, is hedging its bets, and what it means that BRICS nations recently offloaded tens of billions in U.S. Treasury bonds. The question isn't whether change is coming. The question is whether America is prepared for what comes next. Let's start with the numbers, because they tell a story that words alone cannot. In 2024, China purchased approximately $134 billion worth of iron ore from global suppliers. To put that in perspective, China processed over 1.24 billion tons of the mineral, an astronomical figure that dwarfs every other nation on Earth combined. Iron ore is the essential ingredient for steel production, and China's industrial economy runs on steel. Infrastructure, manufacturing, construction, all of it depends on a steady flow of this raw material. But here's where the story takes a critical turn. Beijing is no longer content to pay for these massive purchases in US dollars. Instead, Chinese negotiators are increasingly demanding that suppliers accept payment in Yuan, China's national currency, also known as the renminbi or RMB. According to industry reports from sources like Fast Markets and Reuters, these aren't casual suggestions. They're structured negotiations where Chinese state-backed purchasing groups explicitly request partial or even full yuan-denominated invoicing. Some suppliers have refused, and when they do, consequences follow. Contracts get delayed. Purchase orders are withheld. Access to the world's largest steel market suddenly becomes uncertain. In some documented cases, Chinese authorities have expanded import restrictions on specific companies, like the mining giant BHP, during periods of negotiation standoff. This isn't market competition. This is strategic economic pressure applied with precision. Why does China have this leverage? Because of scale. The Chinese steel industry doesn't operate through scattered private companies making independent decisions. It functions through large, centralized, state-connected procurement networks that coordinate their actions. When these entities act together, they become the single most powerful voice in the global iron ore market. And that power is now being used to reshape not just prices, but the very currency in which those prices are denominated. This matters because iron ore isn't a niche product. It's one of the most heavily traded commodities in the world. And if the currency of trade shifts in this market, the ripple effects will extend far beyond mining companies and steel mills. So how exactly is China pulling this off? What's the actual mechanism behind this currency shift? It's not a single dramatic move. It's a sophisticated, multi-layered strategy that combines market power with financial engineering. Let's break it down into 4 core tactics. First, centralized buyer leverage. China's procurement system is designed to maximize bargaining power. When state-backed buying groups act in concert, they can effectively freeze out suppliers who don't comply with new terms. A delayed contract means stranded cargo. It means ships waiting at anchor. It means cash flow problems for mining companies whose operations depend on predictable sales cycles. This pressure creates an environment where suppliers begin to calculate risk differently. Is it worth losing access to a market that represents 30, 40, sometimes 50% of your total sales? For many companies, the answer is no, and so they begin to negotiate. Second, partial yuan settlement. Beijing isn't demanding full currency conversion overnight. That would trigger too much resistance. Instead, Chinese negotiators propose gradual adoption, maybe 30% of a contract settled in yuan, with the rest still in dollars. Or perhaps yuan-based invoicing at Chinese ports, while keeping international shipping contracts in dollars. This incremental approach is brilliant because it normalizes yuan usage without forcing a dramatic break from existing systems. Once a supplier accepts partial yuan settlement, it creates precedent, and precedents over time become standards. Industry publications like Fast Markets have documented multiple mining companies actively discussing these settlement terms right now. This isn't a future scenario, it's current business reality. Third, port-level currency markets. Chinese commodity exchanges, particularly the Dalian Commodity Exchange, now regularly price iron ore futures in yuan. At major Chinese ports where millions of tons of ore change hands every month, local buyers already operate in yuan. This creates what economists call pricing gravity. When the physical marketplace operates in one currency, sellers face increasing pressure to align their invoicing with that reality. It's simpler, faster, and reduces foreign exchange risk. Beijing gains multiple advantages from this regulatory visibility, pricing influence, and expanded yuan liquidity within the global commodity system. Each port-level transaction settled in yuan strengthens the infrastructure needed for broader currency adoption. Fourth, incentives and consequences. Cooperative suppliers receive rewards, long-term contracts, volume guarantees, streamlined customs processes. Companies that resist face obstacles, licensing delays, restricted port access, sudden regulatory reviews. Consider the example of Hancock Prospecting, one of Australia's largest mining operations. China's regulatory control over import licenses gives Beijing enormous leverage over which companies can and cannot access Chinese markets. This isn't speculation. It's documented in trade press and regulatory filings. Commodity businesses depend on certainty. Predictable access matters more than perfect pricing. When that certainty comes with currency conditions attached, companies adjust their strategies accordingly. Together, these four tactics create a system where trade volume converts directly into monetary pressure. And that pressure is reshaping one of the world's largest commodity markets right now, in real time. Now let's connect these dots to the bigger picture, because what's happening in the iron ore market carries profound implications for American power. The US dollar's status as the global reserve currency isn't just about prestige. It's the foundation of American economic and political influence. When international trade happens in dollars, those dollars flow through the US financial system. Banks, clearinghouses, payment processors, all operating under American regulatory oversight. This creates what economists call network effects. The more trade happens in dollars, the more countries need dollar reserves. The more dollar reserves they hold, the more they invest in U.S. Treasury bonds. And the more Treasury bonds they buy, the easier it becomes for the U.S. government to finance its operations at low interest rates. It's a self-reinforcing system, and it gives Washington enormous leverage. Because dollar dominance means sanction power. When the U.S. wants to pressure a nation economically, it can cut that country off from dollar-based transactions. Suddenly, international trade becomes difficult. Paying for imports becomes complicated. Foreign investment dries up. It's economic warfare without firing a shot. But here's the crucial point. This only works if international trade requires dollars. If major commodities start settling in alternative currencies, the entire system begins to fracture. When an iron ore transaction happens in Yuan between a Brazilian mining company and a Chinese steel mill, that trade never touches the American financial system. It doesn't create demand for dollars. It doesn't flow through U.S. banks. And most importantly, it sits beyond the reach of U.S. sanctions. We've already seen hints of what this looks like in practice. During the first Trump administration, trade tensions with China escalated dramatically. Beijing retaliated by slashing imports of American soybeans, a move that devastated U.S. farmers. Reuters documented the chaos. Crop prices crashed, farms went bankrupt, and the federal government had to authorize emergency agricultural subsidies totaling billions of dollars. That episode demonstrated something critical. When a massive buyer suddenly withdraws from a market, the damage is immediate and severe, and it can be weaponized. Fast forward to 2025, and we're seeing similar patterns emerge again. Fresh tariff pressures have led to new reports of Chinese purchase reductions across multiple agricultural categories. American exporters are feeling the impact. Now imagine this dynamic extending beyond agriculture. If iron ore follows the same trajectory, if major mining companies start settling in Yuan to maintain Chinese market access, we could see export contractions ripple through metals, minerals, and other commodity sectors. That means job losses in mining communities, political pressure on elected officials, emergency government interventions. The visible economic pain would be significant. But the deeper, more strategic risk sits underneath: the erosion of sanctions power. As more trade migrates to yuan-based settlement rails, the port pricing systems, the currency swap lines, the correspondent banking networks, third countries gain viable alternatives to dollar transactions. They can conduct business with China, Russia, or other nations without needing Washington's approval. This doesn't happen overnight. It's a gradual process. But each new yuan-settled contract, each expanded currency swap agreement, each alternative payment system that comes online chips away at the dollar's monopoly position. And once that monopoly breaks, reversing the trend becomes exponentially more difficult. Reuters has explicitly warned about this dynamic expanding yuan liquidity in global commodity markets directly undermines the effectiveness of U.S. sanctions. Because if countries can trade, invest, and settle accounts outside the dollar system, they can operate outside Washington's sphere of control. The question Americans need to ask themselves is this: what happens when the economic tools we've relied on for decades stop working? Here's where the analysis becomes uncomfortable, because it requires examining how American policy choices may be accelerating the very trends they're meant to prevent. President Trump's approach to international trade has been characterized by aggressive tariffs, public confrontation with trading partners, and explicit threats of economic retaliation. The stated goal is to increase American leverage and force better deals. But policy analysts across Asia and Europe are reporting something unexpected. This volatility is pushing nations away from dollar dependency rather than reinforcing it. The logic is straightforward. If you're a finance minister in a medium-sized economy and you watch the United States suddenly impose tariffs, threaten sanctions, or freeze assets based on rapidly changing political calculations, you start questioning whether your nation's reserves should be concentrated in dollar assets. What if your country becomes the next target? What if a policy disagreement leads to financial restrictions? What if compliance costs with U.S. regulations become too burdensome? These aren't theoretical concerns. They're real considerations influencing real policy decisions right now. Beijing understands this dynamic perfectly, and it's exploiting the opportunity. By offering yuan-based contracts, expanding currency swap lines with trading partners, and building alternative payment infrastructure, China provides anxious nations with options. Even if those alternatives aren't perfect, even if they're only partial solutions, their mere existence reduces the dollar's centrality. Multiple expert assessments suggest that Trump's confrontational posture is inadvertently making China more attractive as a trading partner, not because of ideological alignment, but because of predictability. Countries value stability in their trade relationships. When one major partner becomes unpredictable, the other starts looking more reliable by comparison. Reuters has documented rising Yuan usage across several commodity categories in recent years. Financial analysis from Breaking Views notes that partial Yuan settlement is likely to increase as political friction between Washington and Beijing intensifies. Investment flows reflect this shift as well. Portfolio managers are increasingly hedging their dollar exposure, moving capital into alternative currencies and assets as policy uncertainty grows. These aren't isolated data points, they're symptoms of changing incentives across the global financial system. And here's the critical point. Beijing isn't creating this opportunity out of thin air. It's responding to conditions created by American behavior. Every aggressive tariff announcement, every public threat, every sudden policy reversal adds to the perception that the dollar system carries political risk. Over time, those perceptions accumulate, and when they reach critical mass, they translate into structural change. Now let's examine another piece of this puzzle, one that directly connects currency shifts to American government finance. Recent official data shows that BRICS nations collectively reduced their holdings of U.S. Treasury bonds by approximately $47 billion over several months. China, India, and Brazil accounted for the bulk of this movement, with a combination of direct sales and custody transfers that reduced their reported positions. $47 billion isn't enough to crash the Treasury market. The U.S. government bond market is enormous, liquid, and supported by diverse buyer bases. Private sector demand often absorbs what official sector sellers release. But the number matters for a different reason. It represents coordinated behavior by large emerging market economies at precisely the moment they're building alternatives to dollar settlement. What we're observing isn't panic selling. It's strategic reallocation. Central banks are shifting their portfolios in several ways. They're selling long-dated treasury bonds and buying shorter-term bills, which reduces duration risk. They're increasing gold holdings, which provides a politically neutral reserve asset. They're routing more of their trade receipts through local currency channels using bilateral swap agreements. All of these moves reduce the need to hold large positions in long-term dollar assets, and they make future Treasury demand less certain. The U.S. Treasury's TIC reporting, the official tracking system for international capital flows, confirms these shifts. Press releases acknowledge that official sector selling has been offset by private demand, keeping market disruption minimal. But they also note the pattern foreign central banks are adjusting their strategies. This behavior doesn't happen in a political vacuum. When foreign governments fear their dollar assets could be frozen, sanctioned, or restricted during future diplomatic conflicts, the insurance value of Treasury bonds decreases. The calculation changes. Instead of seeing Treasuries as the ultimate safe asset, they become a potential vulnerability. Policy decisions during the Trump administration, tariffs, aggressive trade rhetoric, explicit sanction threats have raised the perceived political risk of dollar asset concentration for some governments. Analysis from multiple financial institutions links episodes of higher official selling to periods of heightened geopolitical tension and trade uncertainty. At a systems level, what we're watching is the slow construction of de-dollarization infrastructure. Initiatives like BRICS Pay aren't yet functional replacements for SWIFT or the dollar clearing system. But they're prototypes. They demonstrate technical feasibility, and they're being actively developed with billions in investment. If BRICS countries successfully scale local currency invoicing, build cross-border payment rails, and expand their currency swap networks, then over time, years, not months, trade settlements and reserve compositions will shift. That fragmentation wouldn't eliminate the dollar's role overnight, but it would fragment the buyer base for U.S. government debt, raising long-run borrowing costs and reducing America's ability to finance deficits at historically low rates. Perhaps the most troubling development in this story involves India, a nation the United States has long considered a strategic partner and democratic ally. India's position is particularly significant because it sits at the intersection of multiple geopolitical pressures. It maintains security partnerships with Washington while conducting massive trade with Beijing. It needs American technology and investment while depending on affordable Russian energy. And it's watching closely as both superpowers attempt to draw it into their respective orbits. Recent tensions have complicated this balancing act. Trade disputes over tariffs, pressure campaigns regarding India's pharmaceutical exports, and American criticism of Indian oil purchases from Russia have all contributed to a sense in New Delhi that the United States views India more as a subordinate than a partner. When nations feel that their economic sovereignty is being constrained, they look for ways to diversify their dependencies. And that's exactly what India is doing. Through the BRICS framework, India is actively participating in discussions about alternative payment systems. It's expanding its use of rupee-based trade settlement with multiple partners. And notably, bilateral trade between India and China has grown for 7 consecutive months. This despite ongoing border tensions and strategic rivalry between the two nations. That growth is significant. It suggests that economic pragmatism is trumping geopolitical friction. Indian businesses and policymakers are making practical decisions about trade flows and currency arrangements, even as the political relationship with China remains complex. For the United States, India's hedging strategy represents a crucial warning signal. If India, with its massive economy, billion-plus population, and growing technological sector, decides to fully integrate into Chinese-led financial infrastructure, the U.S. doesn't just lose a trading partner, it loses a potential anchor for Indo-Pacific economic strategy. The danger isn't that India becomes hostile to America. The danger is that India becomes indifferent to American preferences because it has viable alternatives. This is what eroding leverage looks like in practice. Not dramatic confrontation, but quiet diversification. Not sudden breaks, but gradual drift. And once that drift reaches a certain point, reversing it becomes extraordinarily difficult. So, where does all of this leave us? The dollar's dominance was never guaranteed by natural law. It was built, constructed deliberately through institutional architecture, trade relationships, and mutual dependencies developed over decades following World War II. But what is built can be dismantled. And what we're witnessing now are the early stages of that dismantling process. It's happening in iron ore markets where Yuan settlement is becoming normalized. It's happening in treasury markets where BRICS nations are reducing their dollar asset concentrations. It's happening in diplomatic channels where traditional American allies are building hedges against dollar dependency. The erosion is gradual, which makes it easy to dismiss. Each individual development seems manageable. A single commodity shifting currency denomination, a few billion in treasury sales, one country expanding its currency swap lines. But these developments don't exist in isolation. They're interconnected pieces of a larger structural shift, and they're all moving in the same direction, away from dollar centrality. The question facing American policymakers is whether they recognize this trend early enough to respond effectively. Because the tools available today won't be available tomorrow if the erosion continues unchecked. Sanctions power depends on financial centrality. Trade leverage depends on currency necessity. Political influence depends on economic interdependence. Remove those foundations, and American power rests on a much narrower base. History suggests that dominant reserve currencies don't collapse overnight. The British pound's decline took decades. The transition was messy, painful, and fundamentally altered Britain's global position. The dollar's potential displacement would follow similar patterns, gradual at first, then accelerating as alternatives reach critical mass. We may be approaching that acceleration point. The infrastructure is being built, the incentives are aligning, the political will among alternative powers is solidifying. And once that momentum reaches a certain threshold, stopping it becomes exponentially more difficult. The American financial system has enjoyed extraordinary privileges for 3/4 of a century. The ability to borrow cheaply, the power to sanction effectively, the influence to shape global economic rules. But privileges based on structural dominance disappear when that structure changes. What happens when the world builds a financial system that no longer needs the dollar at its center? That's not a theoretical question anymore. It's the question of our time. And the answer will determine not just America's economic future, but its geopolitical position for generations to come. The signs are all around us. The only question is whether we're paying attention.